Now we're going to talk about an expansion of this accounting equation, and we're going to start with the first part on the left side. Remember I said that left side was important last time? Assets. And assets are pretty easy. Items owned by a business that will provide future benefits or things of value. And examples of that include cash, of course, property, office equipment, supplies, could be buildings, could be something called prepaid rent, because it's something of value that we're paying for in advance. These are all things of value in your business, and therefore they are called assets. Now, there's another one that we talked about that seems a little bit different in nature, but still is something of value. And that's something called accounts receivable. Remember, accounts receivable, abbreviated A/R. What is that?
Money owed to you.
Good. Money owed to us from our customers. They buy a product or service, and they in turn will not pay for it then, but promise to pay for it later. How is that of value to a business? Go ahead.
It lets them know how much in assets they have owed to them still.
Okay. It still lets them know how much money will be coming into them due to the service or product that we gave them. So, does that always happen? No. Some people do not pay their bills, but it's still an asset until we decide that we're not going to collect on it. So again, it's something of value for that business. Assets. Okay, let's go to the next one, liabilities. Okay, look up here. Liabilities are debts or obligations of the business. They can be paid with cash, goods, or services. So, a typical one is accounts payable. What is accounts payable? How is that used? Yeah, when you as a business buy something from someone and do not pay for it then, but agree to pay for it later, that's considered an account payable. You will pay it later, so right now it is a debt for your business, because someday you're going to have to pay it, and it's going to be paid in the short term. Now, another one would be salaries payable. Salaries payable would be employees that have earned a salary from you, but you haven't paid them yet. So if you want to record it in your financial records, you would put it under something called salaries payable, meaning employees have earned this amount, but we have not paid them yet. So therefore, right now, it is a debt. It is a debt. What are you noticing already about liabilities? It's money owed, and they end in payable. So when you see that word payable, it's going to raise a red flag to you saying this is a liability. Okay? Now there is an exception, but we won't learn that till later in the term. But all liabilities that you're going to deal with here at the beginning will have the word payable in them. Okay? And since we've covered assets and liabilities, what's the last part of the accounting equation? Owner's equity. So let's go through that one now. Okay, owner's equity. Another name often is capital. Capital. And in accounting, when we deal with something called capital, we always attach it to the owner's name. Okay, so the owner's name would be prior to it. But owner's equity is the amount by which the business's assets exceed the business's liabilities, just to keep that accounting equation in balance. It's also called net worth or capital. So you'll see those used interchangeably. But for the purposes of our records, we're always going to call it capital. Now, how is owner's equity affected? Good. If we make money, which is net income, our owner's equity is going to increase. If we pay out money or expenses, owner's equity is going to decrease. And the only other time it's going to be impacted would be this one. When the owner withdraws money or equipment or some other asset for personal use. And yes, owners can do that. A good idea? Probably not. It's kind of like paying yourself early, but that's your prerogative if you're a business owner. There is one more thing not listed here that could impact owner's equity. Besides net income or loss, besides withdrawals, besides revenue, besides expenses, can you think of something else that would impact owner's equity? She indicated if they have to add cash. Not that they have to, but what if they decide to invest more money into the business? Yes, that will impact owner's equity. In which way? Increasing it. Can they do something besides adding money to the business? What else could they choose to do? Buy property, buy another asset. Maybe they'll buy a vehicle and give it to the business. Maybe they'll buy some equipment and donate it to the business. Those are called investments. And those impact owner's equity positively. So they make it go up. Okay? So those three categories are the basis for everything we're going to do this term. We're just going to deal with a lot of accounts under them. And you just need to know in which categories they go.